Are we peak bull market or are we just getting started? Is altcoin season upon us? And how important will stablecoins really be in the future? All that and more on today's After Hours. Welcome to After Hours at Traders Post for Friday, September 12th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at Traders Post, joined by Peter, Exit Liquidity Hartman, to break down the madness. After Hours is your go-to live stream focused on macro trends for retail traders, brought to you by Traders Post, the ultimate advanced trade execution engine on this side of the galaxy. But more on that later. For now, let's focus on dollar risk and policy like we do every week. Peter, it's been a roller coaster ride on markets. How are you feeling? How are you feeling? Do you feel bullish sentiment or bearish sentiment here?
Well, I don't know because I keep thinking that the market is pricing in 50 basis points cut, but if they do 25, won't that bring it all crashing down?
Peter, let's not jump ahead. That's going to be information that we touch on at the end of the stream. Very useful and vital information necessary for you to make proper plans for the future. But we can't just give away the golden egg right away. Let's first talk about the setup that we're seeing here. The dollar, Peter. The dollar, if you'll remember, has been consolidating sideways now for quite some time. Remember, we've been talking about this for a clip where the dollar has been basically in this range between 96.1 and 100 for basically since July, right? We've just been sideways here. And the issue with this sideways move with the dollar is that we are expecting the dollar to, when the dollar falls, equities go up. And when the dollar rises, equities go down. Dollar up, bad. Dollar down, good. Well, not exactly. Good for markets. Let's just always make that caveat. What's good for markets isn't always what's good for you and me as an average person. But if you're going to take a trade, we need to know what levers are pulling what. So this sideways move that we've been having with the dollar, amidst this downtrend, the question has always been, hey, is it going to break to the upside or break to the downside? Well, my boys and girls, it looks to be as if the dollar is preparing to break lower. That's right. Break lower. Well, you've seen what's happened here since the dollar broke down before. We've had just a nice rise in equities, and there's no reason to believe that if the dollar breaks lower, that won't continue, at least over the long term.
How low can it go?
How low can the dollar go?
Yeah.
Well, ultimately, I don't think the dollar goes much lower than the 92, which is really low. Really low 92, but it still would be in this uptrend that we've had since 2018, actually since the global financial crisis. Here, if we zoom out to the weekly, you can see what I'm talking about. Basically, we hit a low during the global financial crisis in 2008, and it's been up and to the right ever since. So if we start breaking lower still, as long as we stay above 92-ish, 92.3, it's still bullish. Whether we want the dollar to be bullish or whether we want it to be long-term bearish, that's a whole other kit and caboodle. But for right now, if we get another 1% move down, what's the maximum here? Yeah, we can get all the way to a 5% move down. That would be, I mean, if you think equities are high now, hold on to your britches.
I don't know what britches are, but I'm going to grab them.
Well, here's what I find to be particularly interesting. So the question here is that, so with the dollar down, it also means that there's a debasement of the currency that's happening. So a debasement of the currency, are you familiar with the difference is between debasement of currency and inflation?
Yes.
Intimately familiar. Please educate the crowd. Let's get it on board so everyone knows.
Inflation is when there are Too many dollars chasing too few goods.
Oh, look at that. You got half of it right. That's still 50%, still a failing grade. So let's see if we get the next part.
Debasement is when you devalue the currency.
That's right. It's when you devalue the currency, and it happens within financial markets, either immovable or movable assets.
Don't
You're
sound so
right.
surprised. Don't sound so surprised. I
Well,
listen.
sometimes you have this sort of like doe-eyed look where I'm not sure if you're there or not. If you're all there, I try to give you a little bit of grace because you look like me, so you look like an intelligent person, but you just never know. You just never know. Yeah. So what happens is that people confuse the money printing that the Federal Reserve does or the banks do with inflation, which is not the case. I mean, you can call it asset price inflation, but that's because the currency is being debased, which is why you go, hey, my phone seems to be getting cheaper. Previously, before inflation, that my phone is getting cheaper, but houses and stock prices keep going up and to the right. That's because it's the number go up. That inflationary effect can only touch that where the dollar touches, right? Like you just said, for the inflation, if it's too many dollars chasing too few goods, but the only goods that it's actually touching is financial assets, well, then you have an increase in those assets. So it's asset price inflation. Why am I bringing that up? Well, there's this nasty $35 trillion of debt that the United States is in. Pretty big number. But you know what? There was a big number 10 years ago, and a big number 30 years ago, and 40 years ago, and 50 years ago. It's been a big number for a while. All the good old days where they said, oh my God, we're $10 million in debt. Our country's on the verge of bankruptcy. Yeah. No. Turns out if you have the guns and the reserve currency, you're pretty safe. You can go ahead and print quite a few dinero. So, but there is like a limit to that, right? Donald Trump saw what that was recently with like, hey, we got to refinance this debt. Say what we will, we got to refinance this debt, and there's interest payments to pay. So the question has always been, how is the United States going to get out of this Triven's dilemma, this trap? Well, there's a idea that stable coins from the crypto market will be the asset that the government uses in order to transfer their debt and then the basic currency further, right? Because the way that the basic currency now is the printing of money and bonds and all that. Now imagine they're able to do that in stable coins and print the stable coins and really get rid of that debt. Should be interesting. Well,
isn't this what Russia was talking about?
Yeah, absolutely. One of the Russian ambassadors or finance minister or something like that was talking about the idea that that's why they think that the United States is embracing stable coins in the crypto space, is because their plan is to offload the $35 trillion in debt and devalue that currency pretty dramatically.
Wouldn't that help the world? Because if you want America to be the policeman of the world, you want them to be sort of the managing the seas and all that stuff. You don't want them to collapse under the weight of their own debt. So you put the 35 trillion into the stable coins. It everybody in the whole world basically pays for it, and then the road can continue with America on top.
By good for the world, let's just separate it. It's rich and poor, those who have and those who have not.
Okay.
Right? So will it be good for the wealthy, those who have? Absolutely.
How will it hurt the poor?
No. One more time?
How will it hurt the poor?
Well, as asset price inflation continues, it causes this financialization of the economy,
Right.
where those parts of the economy that are exposed to the financial markets have a benefit. They can either maintain the value of their purchasing power, or they can increase it as the number go up for the assets that they have. So if you just hold the assets, they're going to go up in value. Then you can sell it and get more dollars back. And depending on the performance of that asset, you're either maintaining your value or you're getting more. If you're not exposed to that, if you're in any area that's not exposed to that, well, then there's two problems. One, your purchasing power is not going up. Your purchasing power is going down relative to the assets that are generate yield. And second is that whatever industry you're in, whatever you're doing, there's a propensity for it to become financialized. It's like, well, let's try to find some way of financializing this sector, this asset, this business, or what have you, in order to be able to take advantage of that. So you have this moving away from the non-financial sector towards the financial sector. In other words, the main export from the United States is dollars, and more and more and more people are in the dollar exporting and importing business, to the point where you manufacturing and education and healthcare and all that goes to the sidelines.
Okay, so that makes sense to me. But then the flip side is America falls. How does that help the poor?
Look, we're not in the business of America falling. We're in the business of paying attention to if the number go up or number go down, and how to make money on that on the charts. So I just wanted to go ahead and touch on this video from Robinhood CEO Vlad Levitt, I believe it is. If you guys were paying attention, Robinhood had a summit recently. They have a summit every year, but they had a summit where they basically exploded with all kinds of extra features for the Robinhood platform. Stuff like you can short, you can generate AI indicators inside of the app in order to trade, and more importantly, they are pioneering stablecoins and the tokenization of private equity. What does that mean? It means that they believe that, and I'll let Vlad tell it in his own words here, but essentially the idea is that they believe that stable coins are going to be a huge player in the future, and they are trying to position themselves for it. So we're going to take a quick look here at Vlad Tenev from Robinhood, who is speaking to Kathy Wood and company on the ARK Invest podcast. Let's take a listen.
Folks, particularly in developing countries where the local currencies are inflating or hyperinflating, they go to stablecoin to just get exposure to US dollars as a flight to safety. And that's been a huge thing outside the US. Inside the US, where we already have established ways of getting access to US dollars, it's been really more about the 24/7 transactions and the instant settlement capabilities. I mean, on a corporate level, that's why we adopted stablecoins, because we need to settle up on weekends for our crypto business, which trades 24/7, and the banks are closed on weekends. So if we have to move money between two banks for a counterparty settlement, stablecoin is sort of the best option.
Okay, so he's making the case there for stablecoins being useful. 24/7 markets and the ability to transfer it all across the world very simply, very easily. Makes a lot of sense. Let's see what he says after that.
And I think the future there is a stablecoin that distributes yield, because right now there isn't a strong incentive to hold assets in stablecoin form. So it's purely a point-to-point, almost like a funding rail. You can think of it as a better version of RTP or RFP in the US. So most people just convert to stablecoin, make the transfer, and it's converted back on the other side, which I think in the US doesn't capture the full value. If you want people to hold in stablecoin form, particularly in a high interest environment, we have to figure out how to distribute the rewards to all holders. And that was really the design behind USDG. I think it's going to shake out pretty similarly to for tokenized equities. I think that the benefits outside of the US will be that it's going to become the best way to get exposure to US equities. And, in a lot of these places, it's very, very difficult to plug into traditional equities via their existing rails. But these folks have crypto wallets, right? So I think they'll become the dominant vehicle for US equities distribution outside the US. And within...
All right, so two things here he's talking about. Just keep this in mind. One, you're just talking about the tokenization of assets. That means it opens up the equity market to people who now don't have access to it, right? Not just the equity market, but also private equity. So just imagine all the people in the world who can't open up a futures account, who can't open up a retail trading account, who can't do any of that. Their money, that value, cannot pour into US equities.
Mm-hmm.
Now imagine that flips. And now anybody with a crypto wallet or through the Robinhood app are able to now participate in those markets. Well, then they become even more liquid, and there's even more dollars to be made, not only by the issuing of the equity, but also about all the different participants within the ecosystem, all the different market makers, all the different brokers, all the different all the tool sets used to trade, all the structured products, all that. It completely opens up a whole new vein, right? Especially if we're talking about private equity, those are markets that even regular people don't, regular retail traders who have brokerage accounts or crypto accounts or what have you, they can trade. Just open that up. But then the other part he talked about is the idea that the stable coin might generate a yield. Because right now, if it doesn't generate a yield, you have there's no long-term benefit to holding the stable coin. It just becomes like a way station in between converting it from one asset to another. So you have Bitcoin, you want to transfer it over there, you might turn it into a stable coin, transfer it over, then turn it back to whatever it is you want to be doing, right? Sort of like how cash is. Cash, if you just hold on to it in an inflationary environment, in a debasement of currency environment, holding cash is a liability because it loses value as you hold it. So the idea is that you just want to use it to transfer, because cash is our medium of exchange, just to transfer, and then go ahead and buy this asset, buy that home, buy whatever you're going to buy, because that thing is the actual productivity, that thing that's valuable. But bonds, you do want to hold bonds long term because bonds generate yield. It generates a coupon. And so when you're holding, that's why bonds, it's way more preferable to cash because it's just as good as cash, except that you're earning interest on it. So he's saying the stable coin, if the stable coin like USDG can generate interest, a yield on it, then you have an advantage, a reason to convert your actual dollars into a stable coin, right? Like, why would you hold cash? You'd be like, well, no, I'll just put it in a stable coin. Plus, I'm able to participate in all these different markets. Plus, I can transfer it back and forth and all that, painting the picture for what this could be. Very, very interesting. All right, I just want to finish off this last part.
In the US, it'll be about 24/7 trading and instant settlement, which are valuable things, but very, very, very different than the international value prop, which is going to be very much just access.
And so network effect, just a few at the end of the day?
Between whether there'll be many stable coins or just one, I think they kind of like break down in two categories. So you have the unregulated stable coins like Tether, and that one I think does have a strange type of network effect, because if you're an unregulated stable coin.
All right, never mind all that. Basically, what he's going to go on to say is that either there will be multiple different stable coins competing, or there will be one. All right, and he wants to be on the one team. Now imagine if you put that into if the stable coin is essentially as good as dollars, but better, as good as bonds, but more transferable and accessible, then issuing new stable coins devalues the stablecoin market, devalues the stablecoin in the same way that the debasement of the currency happens in financial markets. So whoever controls the stablecoin controls the world. So when we take a look at Robinhood stock, it is no wonder that Robinhood is now soaring. Robinhood is soaring here. All right. Robinhood is going up. This is the Robinhood stock. So it IPO'd here at $33, and now it's at $115 and climbing. Right? Because if they're getting that game, they're trying to get in early. They want to take them the cake on that. They're doing a bang up job doing it.
Wow.
So interesting. And this whole idea of the remember the USD, what was it? There was this idea of this Fed stablecoin. They floated that.
Uh-huh.
They floated that idea out, and it seems like they tested it out. There was too much pushback, and like they abandoned it. And now the way they're going to go about it is through the stablecoin issuance. So it's pretty interesting. So the dollar going down, crypto policy is pro stablecoin. It means that, hey, the next 10, 15, 20, 30, 40 years could be about stable coins and the debasement of stable coins, and you don't want to ignore it. You ignored it the last time when the dollar is you're like, oh, we're gonna have another 10-year recession and we're in financial markets, and we haven't, because they learned how to do quantitative easing, printing of that money, and now they might have a different system in order to print the stable coins in order to get out. So if you think if they can do that, and you think the stock market is as high as it's going to get, and we're due for a 10-year correction, you better get that out of your head. Tout suite. Not financial advice. Do your own research.
To tweet is French for
right away.
Right away. ASAP.
ASAP. All right. Next up, risk. Hoo boy, folks, guys. S&P, all-time highs. Look at that chart. Doesn't that look unbelievable to you, Peter? Let me just put this up on so you can really appreciate what we're talking about over here. Let's do it. Let's reset this chart and see it all. This is the stock market. Okay? All right, guys? This is a stock market you live in. Up, 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 and away. Massive drawdowns that only last very, very little time. This is all within since 2017, the stock market's been up 200%, double from there. So you go, hey, can it double from over here? Well, excuse me, have you learned about your parabolic curves? An exponential curve grows at a faster rate. So if we doubled since 2017, how long do you think it'll take us to double again? We can have a God candle that happens on this right now. And if we take a look at this on a logarithmic scale, we're seeing that. We're seeing it's basically a straight line since the financial lows of 2008. So the idea that this will march on, I think, is pretty much guaranteed until, of course, it doesn't, in which case it'll fall essentially in a straight line. But that's future Tom's problem. That's not our problem right now. So we take a look at equities. We have S&P at all-time highs. We have Nasdaq at all-time highs, all on the heels of the Fed planning on cutting rates. Remember in Jackson Hole this August, Powell bent the knee and said, enough is enough. Enough with the purple nurples, Donald Trump. I'm going to go ahead and forward guide the rate cuts. And markets have been rising ever since. The thing I'm paying attention to now, because I hate chasing all-time highs, Peter. Not a big chasing all-time highs kind of guy. The big thing here now is Bitcoin. All right, so Bitcoin had been in this lull for a while. Let's just go ahead with our indicator so we can see what it actually looks like. We had this lull for a while with Bitcoin, where it dropped from all-time highs 124 down to 107. And it's pretty dramatic, but now we're having this rise back up, where Bitcoin off the lows has risen something along the lines of 8%, pretty dramatically. I mean, why say that for crypto? When Bitcoin moves, it moves dramatically. So the question here is, hey, if Nasdaq is all-time highs and equities are at all-time highs, shouldn't Bitcoin get there too? Right? It would be hard-pressed to imagine the idea that Bitcoin doesn't get to all-time highs while the other ones are already there. And we're already seeing some of the components within equity markets that are exposed to Bitcoin showing some signs of growth. ARK Invest is picking back up. Look at that. ARK Invest off the lows is up 100%. That's right. And 6 months ago, you could have bought ARK at $38.68, and today you could sell it for a cool $78.57. That's pretty sweet. And you look at that chart, and that looks pretty bullish. If we take a look at MSTR, also look at that run up. That's incredible. That's absolutely incredible, and it's poised to rise still. So we're seeing a bunch of these Bitcoin exposed or crypto exposed equities moving pretty dramatically, which all suggests that funds will start to flow back into the crypto space. Now, the last thing I'm going to pay attention to, as far as two last things for the crypto space. One, give me one second here, Peter. We have if we take a look at the leverage markets for crypto, here we're going to take a look at Bitcoin over the last 30 days. What it was last week is that we had 20 billion short on the Binance, OKX, and Bybit exchanges for some of the liquidity indications. So 20 billion short versus 100 million longs. All right. So it's like a 200 to 1 shorts versus longs, if you guys remember this. Now, the shorts have been liquidated to the tune of half. We're down to about 9 billion. So shorts that got liquidated or had to close their positions. It's down by more than half. Whereas the longs are now up from 100 million to 500 million. It was actually 700 million earlier today, but 500 million. That means the bulls, even though we're not in the billions of territory, the bulls are starting to participate in the bull market. Right? Even though we've been in a bull market for Bitcoin since October of 2023, and we've been up 600% since then, the longs weren't really getting in there. Like leverage longs, really, let's go ahead and put some money behind this and put our money where our mouth is. That wasn't there. And now we're getting this a more long participation. So we're not even to the point yet, Peter, where the shorts are below the longs. Right? We're not even at that point. So we've had this 8% move up, which is about the same amount. Remember, it's about $1 billion worth of liquidations. Shorts is equivalent to about 1% move in the Bitcoin market. So we have that move up. So we have another 9% to go. We can get to all-time highs, no problem. Add to that then the levered longs, and Bob's your uncle. Bitcoin's going to be 150,000, 200,000, just like that. Thanos snap.
Just like that. When
it needs to. It costs what it costs. One of my favorite office lines. It costs what it costs, Michael. But if we take a look at some of the metrics here, we're seeing altcoin season on a bunch of different indexes are basically in altcoin season or about to. Altcoin season is the idea that the other layer one tokens for crypto and some of the other ones, meme tokens and what have you, actually outperform Bitcoin on a whole. Not every single one of the coins, but on the whole, the altcoin scene outperforms Bitcoin. And right now we are blockchaincenter.net has altcoin season at 78%, so well within altcoin season. Coin market cap has us at 69% altcoin season, so just about to get there. You'll notice down here on the list we have so many more coins now that are outperforming Bitcoin. Bitcoin's down here at an 11% performance, whereas rounding up some of the names you might know at the top of the list would be CRO, Link, ETH, Arrow, Solana, ADA, and so on and so forth. So we're having outperformance on the altcoins, and we're not even well within altcoin season yet. If we take a look lastly at the CoinGlass altcoin season index, it's at 78, and we have now just touched into that. So how high can it go? This suggests that we still have 30 to 50% more of the bull market to continue if it's anything like previous markets. We've just now started to touch into it. Oh, so exciting. Exciting.
If you're saying 50% more, how is it that we just now entered? It sounds like we're halfway through.
No, the crypto bull market starts with Bitcoin being bullish, and then partway through there, the risk appetite increases, and people leave Bitcoin and go to the higher risk assets. And so that movement, now that altcoin season has started, according to these metrics, the idea there is that that means we're getting into the euphoria phase, which is the last phase before topping pattern and then crash.
So if risk is going up, why is gold going up as well if the dollar is going down?
Great question. Gold goes up dramatically. When gold goes up dramatically, has nothing to do with retail traders or anything like that, right? Has nothing to do with your no-non papa buying a few ounces of gold and putting it in their basement. That has nothing to do with that. It has to do with central banks buying gold and sovereign entities buying gold as a hedge for the financial system. So when gold goes up dramatically like it is right now, it's actually long-term worrisome, because it means multi-billion, trillion dollars economies are like, we got to stock on gold in case things go badly. But you know what? Things can go, you can get all-time highs for quite a while before. Look, if you're hedging against the collapse of the financial system, it hasn't happened yet. You know what I mean? This is like you're worried about what you're going to do and how you're going to pay your kids' college tuition and how you're going to pay your rent next month, and then they send you another pre-approved credit card in the mail. Guys, I got another 3 months in this. Sure, the crash will be worse later on, but that's future Tom's problem.
So you think there will be a crash later on?
Well, there has to be a crash eventually.
How big of a crash?
Like a Peter Schiff level crash.
Like we need to barter with gold level crash?
No.
I mean, isn't that what he talks about?
No, it's these types of crash. What happens is that, and this is what I find, unless the crash is like it's a war and the country gets overrun and there's a whole revolution and the infrastructure gets destroyed, all the crash happens, right? In a crash, someone else is making money. So what happens is that the transfer moves from those who have now to a new set of those who have. It becomes a new type of an elite system. That's all it means. It just transfer hands. We saw that in Nepal, right? The whole Nepal revolution that happened recently.
Yeah,
there was a whole thing about how they ousted out the people they were before, and then the people who had nothing before. There were like 3 different parties, democratic parties. They all ended up profiting and getting more money and getting more power or whatever. And then the what they call the Gen Z protest, they had enough of that, and then they tore it down. So that was an example of where the previous elites switched and it became new elites, but you still have the concentration of wealth and power. So us as traders, not a social thing, us as traders, as long as there are going to be some assets that outperform, we got to find those outperforming assets.
Right.
That's what the game is. So a crash can be in these sectors, and these other sectors will be up.
So gold is going up because central banks are buying it, and they're buying it because they're concerned about trouble ahead.
Yes, if I'm not mistaken, China is the one who's buying the most of the gold. The thing is, at the same time as they're doing that, I believe they are stimulating their economy. Because normally when you're buying that much gold, you don't stimulate your economy at the same time if you're worried about the financial collapse.
Right.
I mean, I'm saying usually. We're in weird times right now, Peter. But you would expect a pullback in that sort of spending and debt accumulation with the accumulation of gold.
Well, then that will
but you're
create
getting
civil
gold.
unrest, and then the political class will not have as much sway? Or is that different in China? I don't know.
I don't know what their reasons are for doing what they're doing or the effects that it has within their economy. All I know is that the People's Bank of China is buying a bunch of gold.
Right.
Lots and lots of gold. So it's one of the reasons that'll push the price up. So in my mind, whenever I'm invested in gold, whatever I'm trading gold, I just go, are central banks buying it? Yes, it's bullish. If they're not, then it's bearish. That's all I really think about. And the hedging for if things go south, well, what can I do about that?
I get it.
I can't do anything about it. All right, so we're going to be talking about my favorite section, which is policy, in a moment. But before we do, just going to have a word from our wonderful sponsor.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Trade8, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
People are sleeping on Cardano. It's going to be the best performing asset. And hey, so we're about to see one of the most crazy interviews with Scott Bessent, Treasury Secretary Scott Bessent, Dreamboat Scott Bessent, that I've ever seen. Right? It's a 13-minute clip. You want to go ahead and check this out yourself on Fox Business News in order to watch the whole thing. It's totally worth it. We're going to watch a couple of minutes of this and just hold on to your Herman Miller chair, because it is it's pretty incredible. Let's just go ahead and take a listen.
What is this about?
This is Scott Bessent talking about who should replace the Fed. What should replace the Federal Reserve?
What should replace? All right, tantalizing.
Just listen. Just listen.
Joining us as U.S. Treasury Secretary, Mr. Scott Bessent. Treasury Secretary, thank you very much. Can you fix this? Can you and E.J. Antoni, can you get E.J. in there to fix the Bureau of Labor Statistics before any more damage is done?
Well, Larry, good to be with you. And it's a real problem. As you said, if the Fed says they're data dependent and the data has been atrocious, then it seems like there's probably some makeup cuts in order here, or the size of this month's cut needs to be recalibrated. And sure, it could be fixed.
Did you hear what he just said? If the Fed says that they're going to be data dependent and the data is atrocious, the Treasury Secretary is saying this, atrocious, and the data is atrocious, then not only should they be cutting, they should be cutting a lot this month. 50 basis points. They should be cutting 50 basis points. They should have cut a lot. If the Fed is data dependent, are they data dependent or are they political?
I've been hearing this more and more from a few sources. They're like, if they're data dependent, they should be cutting 50.
Shots fired.
Okay,
Shots
so
fired from
what
the
happens
Secretary.
if they don't cut 50?
Right.
Then does it reveal the game that they are? Does it prove that they're political or overly cautious?
What will matter is what's the forward guidance that they provide as they cut 25.
All right.
Because if they can get one, they're not going to want to do exactly what Trump wants, right? They don't want to do that. And if the Fed will always favor forward guiding the markets than actually doing anything.
Right.
They're very much like, well, let's just be charitable.
Why buy the cow when you can get the milk for free?
No, they're more like not con artists.
Not con artists.
They're more like, look, if you get there we go. They're like politicians. If you can get elected on the promise of things,
right,
and you don't need to do it, why waste your time doing the thing? Like, that doesn't make any sense.
Mm-hmm.
Well, the only reason you're promising is in order to get elected. So if they can get the markets to move by doing the rain dance, then do the rain dance. Why do we actually have to seed the skies? Let's just go ahead and rain dance. So right out of the gate, 30 seconds into this thing, he goes, hey, if the Fed is data dependent and the data is terrible, they should be cutting 50 basis point or more.
Anything can be fixed. You just have to first, we had to establish that it was broken, which President Trump did. Now we have to go about fixing it. And it wasn't working well before, that kind of this lazy notion that they had dropped down to these low response rates, 30, 40% response rates, and they intuited the balance. Intuiting the balance is going from quantitative to qualitative.
So what he's saying here is that the data was so bad. Remember, we're talking about the revisions to the jobs numbers, where there's millions less jobs than was initially reported a couple of years ago. And so they're saying, well, the reason that's been given for why those numbers are so bad, why the revisions are so dramatic, is that the participation rate for those surveys were low. And so they had to extrapolate out what those numbers are, and those errors, when you extrapolate out from lower participation, get exacerbated.
Why is the participation lower?
I don't know. I don't want to guess, but they were lower. So it's like, well, you should have better ways of gathering the data,
Right.
or
It's not
extrapolating
new.
the data. How could you be so off where you're off by millions? So he goes, the Fed sucks as far as they should have cut already. The data is terrible. And how are you even collecting the information is ridiculous. The whole thing is crazy.
I mean, they're off. Like, I get that they're always off and they're always making these corrections, but they're off now, from what I understand, like 6x more than they normally are.
Right.
You know, they're normally off by 0.1 and now they're off by 0.6. It's like, how do you accidentally do that?
Let's hear what Bessent has to say here.
Good empirical data, and it's not easy to get to, but you got to want to get there, and we want to get there. I think EJ is a great person to do it. I've known him for years. He's high integrity, data driven, the ruthless truth pursuer.
Secretary, you mentioned recalibrate this month's meeting. It's an interesting point. Maybe they should go a half a point. And a lot of people think, very distinguished people think, that we ought to be at 3% Fed funds rate by the end of the year. We're at 4.5% now. Seems to me they're going to have to make some larger moves, in light of these numbers. But also, you've got market conditions, as I said. Dr. Copper's gone nowhere. Lumber prices are coming down. The curve is still inverted. Things of that sort. Maybe the Fed.
Those are all recessionary signals. Dr. Copper going nowhere. Lumber is down, which means housing is down. Yield curve inverted means there's stress within the funding system. And he's saying that experts, people very respectable, are saying we should be cut by 150 basis points by the end of the year. There's only three meetings left, so they're calling for 50 basis points again, and again.
What? I can't imagine that could ever happen.
Well, absolutely, of course it could happen. Why couldn't it happen?
How do you go from not cutting to 3 times 50?
I think 50 is like the new normal now.
Oh, yeah.
All right. Just like QE, that's it. The idea that we go back to 25 basis points, that to me seems like crazy. That's why my bet for on poly market that they're going to cut 50 basis points in September, I'm still taking that bet. Because I think is more than a 10% chance that they go like, hey, let's do. Can you imagine if they do 25 and the market falls because of it? The whole reason they're cutting is to stop the market from falling. Then if they have to come with an emergency rate cut, oh my God, you know how embarrassing that's going to be? Oh my God, that'd be so embarrassing.
But you told me that if they cut by 50, and I guess another 50, that if inflation goes up, they have nowhere to go.
Fine. But the inflation numbers are showing not only is inflation not going up, like the surplus of revenue because of the tariffs and we would have expected a slower rate of inflation. It is like not going up.
Okay, but the tariffs may all be squashed. It's going to the Supreme Court. They're saying that these generalized across the board tariffs may be illegal.
All that matters here, remember, we're not trying to decide what's going to happen. All we need to decide is what the market wants to happen. So the market prices in what it believes should be the fair price. As long as that pricing happens before a decision date, that's where the market will be. And it'll only readjust if some new information comes out. So let's say there's going to be that court case. Well, we're going to find out at some point when there's going to be a decision date. Well, up until that date, whatever the market's pricing is what the market's going to price in. It's not going to suddenly change. Right? The market, what it doesn't want is volatility. That's what the market doesn't want. That's it.
I thought the market does want volatility because that's where you can make the most amount of money.
Volatility is where you can make the most amount of money. But the market, the mechanism of the market, doesn't want volatility.
Right. I get it. I don't think I've ever been as excited for
Fed meeting.
then the 17th. I'm gonna watch it like the Apple event. I'm like, all right, here we go. I'm gonna
That's
live
right.
tweet it.
Every word.
Oh my God.
All right, let's hear the rest.
Fed will recalibrate. Maybe they should.
Well, they should. Let's see if they will. That as John Maynard Keynes famously said, "Sir, when the facts change, I change my mind. What do you do?" And it turns out that we didn't have good facts.
Yes, right. Absolutely. So let me ask you about Fed membership. First of all, Steve Myron, CEA chair,
right.
taking a leave of
Let's skip that
absence.
part. They're going to just talk about the makeup of the Fed. Essentially, there's this whole fight, right? Lisa Cook, one of the Fed chairs, was fired. Well,
No.
whatever.
They stayed that. It's going. I think it's going to the Supreme Court as well. On the appeals court, I think blocked it.
Okay, sure, fine. But the idea here is that there's all kinds of machinations happening behind the scenes where Donald Trump is trying to influence the voting decisions, even to the point of being like, "Hey, one of you guys could be the next Fed chair, so you don't have to vote my way." I'm saying,
Do you want to be
looking for a
king?
new Fed
Do
chair.
you want to be
Yeah.
king?
So
I'm just saying,
let's
if
jump
anything
here.
happened to the king, yeah, sorry.
So Bessent wrote an article for the Wall Street Journal recently called, I think, "Gain of Function," something for like financial markets, basically tying this whole idea of like the COVID mishandling with how the Fed is mishandling markets. Let's see what he has to say here.
Secretary, you wrote, let's see, it came out last weekend, your latest op-ed piece in the Wall Street Journal, and you basically called now for a top-to-bottom review of all of Federal Reserve operations, monetary policy, regulatory policy, staffing, regional reserve banks, and the like. Tell us about that, because this sounds like a blueprint for a new Trump-oriented Federal Reserve Board.
It's not a blueprint for a new Trump-oriented Federal Reserve Board, Larry. It is a blueprint for a Fed that values its independence and monetary policy. Because of this gain of function, monetary policy and mission creep and bloat that the Fed has had, they are risking their monetary policy. That, I believe that the Fed should be able to set monetary policy on an independent basis, but the more creep we see within their mission, then the more it threatens their independence. And look, they covered themselves in glory in this decade. We had the worst inflation of 40 or 50 years. We never saw a post-examination of why things went wrong, how we could keep it from happening again. Regulatory policies, we saw the Silicon Valley Bank and the other two banks that went under, we saw that get swept under the rug. And the independence of the Fed exists because they have a special relationship with the American public. They get to be appointed without budget constraints because the American people believe that they are above reproach. And again and again, drifting away from the central mission has just caused so many problems. That editorial is part of a much longer 15-page piece in a magazine online called The International Economy. I'd urge everyone to go and read that, because
Okay, so he just itemized all the things that are wrong with the Fed. He goes, "Look, your data is terrible. You presided over the worst inflation seen in decades. Your response is horrible. You're trying to," and the undertone here, the gain of function undertone, is that you're trying to weaponize monetary policy against the administration. And the American people want to see a nonpartisan Fed, blah, 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 yada, yada, yada. So he tells Kudlow, "No, we're not trying to get a Trump-specific administration within or governance body within the Fed. We just want them to do what they need to do," which is politicians speak for. Yeah, we're going to need them to cut. We're going to need them to cut rates pretty dramatically. Let's just go ahead and cut those rates pretty. Can we cut 10%? Let's just cut 10% and be done with it. It's crazy. The rest of the interview, it's just as exciting. I mean, I'm very wonky. This is the sort of thing I very much enjoy. You guys got to go take a look at it because it's Treasury Secretary wrote a 15-page report on why the Fed needs to change. It's a whole campaign going on right now. This is like the Ron Paul glory days of audit the Fed and all that sort of thing. I've never seen this hornet's nest be kicked the way that it is right now. And like you said, coming next week is Powell at that podium, and I cannot wait.
It's
Fire.
gonna be wild. Tom, if I almost want them to cut 25 just so I could see what happens.
Poly market bet needs them to cut 50 basis points. I don't see how they can cut 25, because if they cut 25, now it's the fight. Like, they have to explain how the data is so wrong, the jobs are so bad, and yet they're only going to cut 25 basis points. How are they going to do that?
Because of the uncertainty of tariffs. They're going to keep on with the same thing that they've been saying. The wild card here is tariffs. They don't know if it's going to cause inflation. They don't know if they're going to be upheld. It's a whole thing that's happening here. It's not a normal situation that they're dealing with. They're dealing with an abnormal situation. They don't want to be blamed for it. If things go wrong, I imagine it's better for them to say, well, it's their fault and we were cautious, as opposed to we cut, and now something happens, inflation starts to skyrocket, and they got no more ammo.
Except the whole wait and see approach. You have increased revenue intake from the tariffs. You have no significant increase to the inflationary rate. You have consumer spending, higher than ever. I think it's at 10 billion, I think, way more than expected. You have, and then on the other side, you have the data that the Fed is supposed to be following. That's way worse.
Okay, but you said people are not buying houses. There are massive job losses, and then there's uncertainty when it comes to policy.
Well, people aren't buying houses, but the housing inventory has skyrocketed.
Yeah, the inventory is skyrocketing because millionaires now, they're renting instead of buying.
No. That doesn't account for the amount of skyrocketing that we had. We're getting this large increase because there's a cost to owning the homes, and they don't want to just keep on holding it. The idea is they were going to hold these houses and more people will come and buy it and keep the prices high. Now it's like, well, that's not happening. For any number of reasons, people aren't buying these homes, but the homes are a cost to whoever holds them. So the inventory is going to increase, and the idea is that the prices can come down. But you have the jobs numbers are the smoking gun here. 2.1 million jobs that are not actually there. That's insane. That's not like it started now. That's been for 2 years.
Right.
So they've been trying to be data dependent. We're going to see what tariffs are during your watch. You can't count the jobs. Your mandate is jobs and prices. The two things you're supposed to do, jobs and prices. You can't count the jobs. So he's like, what are you going to do? So they're going to come out and do 25 basis points. And what are they going to say?
You don't think
questions, the jobs numbers are so terrible. How can you, these numbers that if we saw that before Trump and all that, you would have already been cutting.
You don't think the deportations have anything to do with those job numbers?
Yeah, of course it does.
So that's another uncertainty. You don't know how many people are going to be leaving.
So then you should cut. Then the Fed should cut. All that means the Fed should cut. These are all reasons for cutting. Peter, very respectable people in the space have called for 50 basis point cuts for every meeting until the end of time.
But there have been other respectable people saying they're going to cut 25.
Are any of them Donald Trump? He's the only respectable person I care about.
Oh, okay. All right.
If anyone knows about monetary policy more than Trump, I don't know who it is. I don't know who it is.
Okay. All right.
All right. That's been fun. You guys got to go take a look at these clips. The times we live in is pretty astounding. And this is just looking at fiscal and monetary policy, not even all the other stuff going on. So as traders, it's our job to get this information, trade accordingly, invest accordingly in order to make money for ourselves and our family and to survive over time, because there's no point in lamenting the news. Best to trade it. Peter, anything you want to say before we head off?
Exciting times. I'm really happy that I have a source like Traders Post in order to get this news, to figure out what's going on, and to, hopefully get into the markets there and start trading it. Been really enjoying Price Action Live, so I want to remind people that there's more than just aftermarket commentary here on this channel. We have Price Action Live that happens Tuesday, Wednesday, and Thursday at 9:15 a.m. Eastern Standard Time for about an hour and a half. So definitely check that out. If anybody out there, you're a trader, you want to come on to the show, we're open. Let us know. And if there's anything you want to see on Blueprint, which happens on Thursdays, or questions you have on Tuesday for office hours, we're all ears. Lots of exciting stuff is happening, Tom. Where are you going to be on the 17th?
Glued to my computer screen, as always. I'm always glued to my computer screens. I don't care about, Peter, the only things I care about are things that move the squiggly lines on the chart. I don't care what asset it is. If it's not moving oil, if it's not moving gold, it's not moving Bitcoin, it's not moving equities or whatever, I really don't care about it. I really don't.
I see.
So after the Fed, oh my God, when that Fed meeting comes out, those minutes, because the minutes drop at 2 p.m., right? So 2 p.m. on the Wednesday, the numbers will come out, the markets will go wild. Then he's going to talk and the markets will go wild again. I mean, how can you not watch that? It's better than any Super Bowl.
I think I might be shorting the market on the 17th.
Yeah, but you don't want to short the market into, I don't know, do you? Imagine they don't cut
at all.
Imagine they go, oh, we're gonna pause.
We're still waiting. All right,
guys. Happy trading.